Okay, well, thanks very much for inviting us to do this. I'm Andrew Leyshon. I'm Professor of Economic Geography here at the University of Nottingham.
Hi, I'm Shaun French, Associate Professor of Economic Geography here at Nottingham.
We're both economic geographers, so we're not economists. So I suppose the extent that we engage with economic work, we engage with it in a very sort of heterodox way with heterodox economists, and I know Gary Dymski has spoken in this seminar before. We've both drawn on his work and work with his colleagues, and we know Gary. And we also draw on other economic research in business and economic sociology. So we see it as a sort of a broad church of work that we do in economic geography, but with a particular focus on space and place, and the way in which these things fall out, and the way in which geography makes a difference to the unfolding of economic processes. And between us, we've been working on money and finance and financial exclusion inclusion for quite a long period of time. Me for longer than Shaun, because I'm quite a bit older than him. But Shaun's doing some, I'm not doing so much in this area anymore, but Shaun is doing some very interesting work, and he'll talk about that towards the end. So what we thought we would do is divide this into two bits, really. If I start off and talk about the context for financial exclusion work, and the way in which that unfolded, and then Shaun will talk about some of the problems with the concept of financial exclusion. So I'm just hoping this will. Oh, there we go. So we've divided this into four parts, really. I'll do the first two, and then Shaun will do three. And 4 and 3 is quite substantial. So there's lots of bits in that, really. So I'll talk briefly about financial exclusion, inclusion as an issue, and the way in which I originally got into this, about the idea of trying to map financial exclusion. And then Shaun will look at some of the pushback, really, against this idea in different ways, and the way in which this issue has been evolving.
Excuse me, Andrew, Shaun. Just to all participants, please, we're using this new software, and I would like to ask you to mute your microphones if you're not the presenters, because we just heard some background noise. There should be a button somewhere on your, I think, bottom left to mute your microphone, okay? Please. Thank you, everybody. Okay.
Sounds like something exciting is happening somewhere, I must admit.
Yeah. Something is. Okay, sorry.
Right, no worries. Okay, so so financial exclusion. The reason that I first got into this, and it was in the early 1990s, and it was as a result of some consultancy work that was actually put my way, and the person I was working with at the time, Nigel Thrift. We were asked to do some work for a local authority in the UK. Who were based in the southeast of England, and they were kind of concerned about financial services that had been an important part of employment for them, but they were worried that this was somehow going away. And we started looking at it was really about processes of decentralization of financial services, which I'd previously looked at in some work. And it was when we were kind of thinking about ways to approach financial services that we suddenly came across this literature on. It was actually on social exclusion. This was a growing concern at the time, and the two things kind of married, really. That we thought about this issue of social exclusion, and then changes in finance, because there'd been a financial crisis in the late 1980s in the UK, and there was a withdrawal of business away from people they'd previously been looking to enrol, and then by harking back to some work that we'd done in the 1980s on the debt crisis of the early 1980s, the less developed countries' debt crisis, we began to make an association between, well, what happens in crises is that financial institutions often withdraw from particular places. We decided that this was something we would kind of begin to look at, really, and it got quite a bit of traction. So that's how we got into it. And around about the same time, this partly it was some of the work we were doing, and other people were working in this, particularly in some sort of policy areas, that it began to get some traction in the UK through the 1990s, as people began to notice that bank branches in the UK were beginning to close. There were problems of getting access to certain kinds of financial services. But it really got traction with the election of the Labour government in 1987, who decided to make this issue of social exclusion a key policy measure, and they began to do work on this and initiated some policy action teams on different things, and one of them was on financial services and on financial exclusion, and they then became defined as an issue. So it's quite interesting for someone who'd kind of done this work in a sort of abstract theoretical way to social research, to see how that was then translated into a policy object. And it was a way in which the Labour government thought they could intervene in social problems by tackling financial problems. And in one sense, it was an open goal, because if you can do policy that somehow blames the banks for social ills, then no one's really going to complain about that apart from the banks. So it was a vote winner in that sense. And a whole series of policy documents and things came out around about this time through quite an intensive process of policy experimentation and rollout. And then it got wider traction to beyond the UK into other jurisdictions as well. And so the European Commission in 2008 even come up with a definition. So it's a process whereby people encounter difficulties accessing, using financial services or products in the mainstream market that appropriately needs and enable them to lead a normal social life in the society to which they belong. So, there was interesting grey literature around in the 1990s actually talking about this, that financial services is a service, but it's a different kind of service because it's so essential to being able to live in a contemporary capitalist society. And so one of the things that people talked about is that the way in which pay, which had previously been in the form of cash, had become mediated through bank accounts. So if people didn't have bank accounts, and that in some cases that there were some people who didn't have bank accounts in the 1990s, then they had to open a bank account so they could get paid. So there was also discounts that were offered to people who would pay bills through direct debits or through bank transactions. And again, it was seen to be discriminatory against certain people who didn't have bank accounts, who were strongly associated, those with limited cash, limited income at the top of the social strata. So this began to be picked up in a number of different areas. And again, and two people who were particularly important in this in the 1990s and early 2000s, Elaine Kempson and Sharon Collard. And again, the kind of definitions. Financial services is an essential part of everyday life. And if you don't have access to financial services, it can lead to detriment. And this notion of financial exclusion, that you're being excluded through certain parts of society because your inability to access the full range of financial services, which provide an important role in society in terms of smoothing income and deferring payments and so on, and speeding up transactions. So a wide literature was being developed. And Kempson and one of our other collaborators, Claire Wiley, very usefully came up with this categorization of different types of exclusion that people might suffer in the face of financial services. So the first one, which was access exclusion. So this is like physical access. So it's a classic one would be if a bank branch or a facility closed down, then it wasn't there anymore, and it would be more difficult for people to access it. And Shaun and I have written about this in the past. We had a little vignette of one example of somewhere in a remote part of the UK where a bank branch closed down, and there was a considerable journey that someone had to make to do that. And why is that important? Well, often in terms of just getting advice. If you're a small shop owner, then you're taking cash, then you would need to kind of put it in the bank. So there are inefficiencies and hurdles and burdens that occur if you don't have physical access. But there's also exclusion through conditions. So if you don't have the right kind of socioeconomic profile, then you wouldn't even qualify for getting certain financial services, price exclusion, just because people can't afford it, marketing exclusion, which is where people don't even know about these things because then there's a sort of selective marketing of certain products to some people and not others, and combining this with other spatial geodemographics to make sure they concentrate their activities in particular areas. And then of course, which is Kempson has written quite strongly on this, is the idea of self-exclusion, that people think, well, this is not for us. These are institutions that are not really meant for people like me, and therefore they don't try and engage with it, so they become excluded that way. So I'm sure there are other forms of exclusion as well, but these are kind of 5 main types. And so a whole series of attempts were made then to measure the extent of exclusion, and it's something of a movable feast in terms of how you measure this, but one would be access to a basic transaction account so that you could put money in and you can use it to pay various vendors or to pay various transactions. And you can see that this is a European Commission data. This is from nearly 10 years ago now, and you can see it varies quite strongly between those that are banked or those that are marginally banked. They have some access or unlimited access, and you can see that it, in some cases, it goes up to quite a significant proportion of the population in different places. And again, this becomes identified as a policy object. And as this literature rolls out, there's something in the UK called the Financial Inclusion Commission. I think Shaun will refer to this again later, that they've made various calculations about how this costs people. So there's a thing like a poverty premium, because if you don't have access to financial services, you would have to pay more for things. For paying energy bills, if you wanted to pay with cash, you had to have a meter. That would be more expensive than paying transactions. Or if you didn't pay with direct debits, they would it could work out more expensive. They would have different tariffs for different forms of payment, and there's other kind of data on there that you would be able to see that people don't have access to these things in the UK, or didn't then anyway. And linked to that, as well as not having access, it was kind of recognition that there was a problem of something described as financial literacy or financial knowledge, or the ability of people to understand, comprehend, and really work their way through a financial landscape. So there's a problem that people don't have sufficient knowledge to understand even basic financial products. But as some other researchers illustrated, in a lot of where this is a real problem, it's not just financial literacy, it's kind of literacy. So it kind of affects certain kinds of population more than others. And again, that can cause all kinds of problems in financial hardship if people are not acting in a way that a lot of people would assume you act in with a kind of linear subjectivity, that you're thinking actively about your finances and planning forward. People often don't do that, and again, Kempson's work's been particularly good in revealing that often finances can be quite chaotic at the margins, because people just don't, a sudden demand for things can create all kinds of problems. The problem is not enough cash, as well as not the inability to kind of mediate these through a bank account. And so what happened then? So the initial research in this area focused very much on this idea of financial exclusion as the problem, and the way that this manifested itself as a whole series of social problems. And then it got translated into a policy instrument, which was creating financial inclusion. So if the problem is exclusion, then the policy response is to engender inclusion. And there's various definitions here about if people are excluded, they become included because they now have access to services. And there's a kind of nice quote there from the Financial Inclusion Commission. It's about ensuring that every adult in the United Kingdom is connected to the financial mains. What they mean there is almost like a utility, a kind of electricity or gas, just as she is connected to the mains electricity or mains water. So they are able to access financial services which are compared directly to a utility, that they're so essential to living in a contemporary capitalist society that therefore people should be able to do that. And Shaun will say something about these ideas later when we're talking about financial citizenship. So our initial point of contact with this really was to, as well as engaging with financial exclusion, is thinking about the spatiality of this, really, in thinking that there was an uneven geography to financial exclusion. And some of the inspiration for this came from work in the United States, where people had for a long time talked about redlining. And it's quite interesting if you go back and find the origins of redlining. It's actually part of the New Deal reforms in the United States from the 1930s onwards. And redlining was seen as a kind of a positive thing, ironically, and it was trying to encourage banks not to lend in areas which were seen to be risky, because they didn't want these banks to undermine their assets, and that's kind of where the term came from. But then it increasingly became a pejorative term because it was associated with the geographical location of certain groups. So here's one from 1936 from a kind of savings and loans corporation of Philadelphia, and there's one from Baltimore and Charlotte, and they were, the redlined areas these were freighted with all kinds of pejorative interpretations of ethnic minorities, both African Americans and Jews. But this term got traction in the United States, particularly after the riots of the 1960s in key cities. And as a result of that, which was partly seen to be a problem of insufficient financial investment, and a whole series of acts in the United States, first of all, the Home Mortgage Disclosure Act in 1975, where savings and loans had to reveal data on where they were lending, and then the Community Reinvestment Act, where financial institutions had to reveal data on, again, where they were lending and investing, which they had to show they were serving all communities, although only in line with good business practice. So they weren't supposed to do things that would lose them money, but they had to show that they were not being discriminatory on any other grounds rather than financial practice. And it was this work that really led to, something that was very inspirational, I think, for this work in this field. And that was the work of Gary Dymski and John Veitch in the initial formation. We did this work on financial dynamics, where by using this data, he could see where money was actually going into the financial system from various households across Los Angeles, but actually the money was only going back out to certain places. So you could see how money was being recycled through an urban environment, but was actually then being disproportionately lent back to more affluent areas. So you could see how these areas then were constantly being refurbished and invested in and improved, whereas other areas that may even have had access to the financial system in the sense they were kind of putting money in, but they couldn't get the money back out. So those areas would fall into disrepair. So you would get this is why you call it financial dynamics, and leading to uneven development. So that was kind of really interesting, and we were thinking this would be a good thing to do. But in the UK, we couldn't do that because we don't have that data. So we were thinking, well, what can we do to look at these spatial processes of financial exclusion? So we used bank branches as a proxy. And my colleague Nigel Thrift and I got an ESRC grant, which is the Economic Social Research Council grant in the mid-1990s. And this was in the days before big data. We actually employed someone to go through a large number of directories to extract this data to create a database to look at bank branches, initially in 1989 and then in 1995, and compare the two. And what we found was this processes that were happening in the United States as well of banks closing. Now, in the States, that was partly to do with the reform of the Glass-Steagall regulations, where you could now have money center banks and investment banks coming together, and the spatial restrictions were taken away. So that encouraged a bank merger wave, and there were kind of lots of closures. But what we found in the UK was that there were large closures going on that wasn't anything to do with this merger wave. It was to do with a different form of rationalization. And this database, which, as I said, started in 1989 initially 1995, but then Shaun and I have updated this twice for 2003, 2012, and we're hoping to do that again. Has illustrated that over this 20-year period, that there's been a decline of 40% in the number of branches of banks and building societies who are the UK like savings and loans. They lend predominantly for housing, or they do all kinds of other things these days as well. And what we did is try and look at this in relation to certain geodemographic areas by using a fairly crude categorization, but you can that's quite complicated. So I'm not I'm not even going to go through that at the moment. But these are different types of areas, and this kind of gives some partial explanation. If you look at the far right column there, 1995 to 2012, you can see areas of decline, and built up areas, traditional manufacturing, student communities, prospering metropolitan. So kind of inner city areas, traditional industrial areas have had high rates of closure. There'll be some openings elsewhere, but they tend to be in more kind of rural, suburban areas. And I'm going to finish on this. And one of the reasons that we've speculated for this is that there exist what we've described as financial ecologies. And this is this betrays our geographical background here, I suppose. It's the relationship between certain institutions, certain actors, and geographical space. So you can see this within the financial system. There are certain kinds of arrangements in space. So the main engine of the financial system, certainly in the UK, in the United States, and probably globally, is the suburban ecology. This is the prime part of the financial system, if you like, where you have these houses that are being mortgaged. You have people in jobs bringing money in, is going out through the mortgages and into the financial system. But you also have what you could describe then as subprime ecologies, and we've got some examples of those there. We could use examples from the United States as well. They're kind of on the margins of the financial system. At various times, the financial systems are either kind of withdrawn or wanted to move into this to make profit because they can see different types of return. So it's kind of interesting that it was the subprime crisis was enough to almost bring the financial crisis to its knees. So you can imagine what would happen if there was a crisis within the prime part of the market. And you have different types of institutions traditionally who would be aimed at these different types of markets. So the main market of prime is where the financial institutions want to do most of their business. Traditionally, the subprime market would have been made up of specialized institutions, but as I said, over time, mainstream financial services looked at this because it's expensive, quite hard, quite profitable really, and they've tried to move into it. And you can see that with subprime, and you can see that with other kinds of techniques as well. So I'm going to hand over to Shaun now. He's going to do beyond financial exclusion.
Thanks, Andrew. Okay. What I want to do, first of all, just to provide some context, what I'm going to say in the second half is say a little bit about some work I've been conducting over the last couple of years here in Nottingham. And based on the research I conducted with Andrew into geographies of bank branch closure and the geographies of financial exclusion more generally, I was approached about 2 years ago by a number of debt advocacy groups in Nottingham to see if I could get involved in the development of a partnership to try and address some problems of very significant problems of financial exclusion in the city of Nottingham. Now, Nottingham experienced significant deindustrialisation in the 1980s, early 1990s. Key industries used to be coal mining, textile industry, most of it's gone now. And as a result of that, the city has continued to have to grapple with high levels of unemployment. And it also has a very high level of over-indebtedness, below the average levels of household income. So the city is high up in terms of these sorts of measures of financial exclusion. And people like the Nottingham Credit Union, Advice Nottingham, which is a group of debt advisory agencies, approached me about trying to develop a partnership, develop a financial inclusion plan for the city to try and address some of these problems. Now, for me, that was a great opportunity, having conducted some of this work at a relatively abstract level, to try and see if I could translate that work into a sort of a practical agenda to actually help people on the ground. But it also raised some really important issues as well. And that were around the fact that financial inclusion as a sort of policy objective has become sort of almost depoliticized. It's been widely accepted as a good thing by political parties both on the left and right in the UK, and it's become arguably hegemonic, not only in the UK, but also internationally. So the United Nations, the World Bank, all of these organizations have sort of financial inclusion policy initiatives in place to try, as a means to try and address issues around uneven development and around poverty. Okay, but at the same time, over the last 5 or 6 years, there has been a number of really important critiques that have been levelled at the idea of financial inclusion, both as a policy initiative, but also as a concept. And I would just want to set out what I think are 3 of the sort of key critiques, 3 of the limitations of the idea, the sort of binary financial inclusion, exclusion. The first relates to really the restructuring of the mainstream financial services sector over the last 10, 15 years. And in particular, the adoption of things like risk pricing and an attempt to open up new markets through the emergence of subprime, etc. What this really does is this raises significant problems for thinking about or trying to categorize financial exclusion and draw a line between people, individuals, communities, households that are included, that have access to the sort of mains of financial service sector, and those that are deemed excluded. So, because it really blurs the boundary between inclusion and exclusion. Okay, and this is also because a lot of in the UK and in terms of in the global south, in terms of microcredit institutions, a lot of those sort of alternative subprime organisations are actually dependent on financial inclusion policies and initiatives to open up new markets. So that raises all sorts of, I think, really interesting and important issues. In response to that sort of blurring of the boundaries between included, excluded, there have been attempts to sort of recategorize the subprime market in terms of its level of exploitation and the relative level of sort of financial exclusion. And I've just, on the slide, there's just one of those examples from a couple of years ago, a sort of sliding scale of of exploitation in terms of the subprime market. But that makes it really difficult, I think, in practical terms to sort of think about inclusion and exclusion, that binary. Second limitation, I think, of the concept of financial inclusion is about the actual failure of these policies in their own terms to make significant inroads in terms of issues of poverty and socioeconomic marginalisation. So in the UK, there has undoubtedly been a lot of success in terms of reducing the number of individuals who didn't have any access to banking services, and in particular reduce the number of unbanked individuals. But that's led to a wave of, over the last 5 or 6 years, new research that basically questions how effective that has been in terms of improving the life chances of those individuals who normally become a part of the mainstream financial system. So there have been questions around the charges that are levelled for people using basic bank accounts in the UK. There have been questions around how many of these basic bank accounts are effectively dormant, so people either aren't able or aren't willing to use those bank accounts, and also questions around the ability of people to migrate from basic bank accounts to more sort of mainstream current accounts, which have things like overdrafts. And normally the solution to those sorts of problems in terms of the sort of financial inclusion policy community is basically to argue for more financial inclusion policies, more financial education, more financial capability programs, rather than fundamentally trying to question the aims of financial inclusion policy. And that brings me on to that, I think the third and probably the most important limitation of and critique of financial inclusion, exclusion policy and literature and the concept is that a number of theorists, critical social scientists, have basically argued that it really shifts attention from the attention away from the sort of structural determinants of things like inequality, of uneven development, and it sort of individualizes the problem of poverty. So the problem's really about, and that's really emphasized in terms of the focus on financial literacy capability programs. So it's really about the individual's inability to be able to understand the financial system, to be able to navigate their way through the financial system, to be able to put in an application for a bank account. So poverty is sort of a process of sort of neoliberalization, or complements process of neoliberalization, arguably, a focus on financial inclusion and financial inclusion initiatives. It sort of, as I say, diverts tensions away from arguably the root causes of poverty and inequality, and rather it becomes, in the terms of some critiques, a way in which to manage poverty, to provide the tools for poor people to manage their own inequality rather than addressing the root causes of that inequality. So for me, this raises really important questions, because on the one hand, you've got this still dominance of the notion, the discourse of financial inclusion within the UK and further afield, and certainly within policy circles. But then on the other hand, there are significant political problems and limitations in terms of that concept. So what are we to do? One approach is to start to try and think an alternative sort of conceptual language to address the sort of distributional politics of contemporary financialised societies. So in terms of the work I've done in Nottingham, rather than use the term financial inclusion, we've used a broader concept of financial resilience, which is to try and capture a sort of broader dynamic of inequality related to financialisation that may or may not be related to financial inclusion or access to mainstream financial services. And what's nice about the concept of financial resilience is that it moves beyond that sort of the binary of being included or excluded, and allows you to then think about people who are sort of nominally included within the mainstream banking system, but might be heavily over indebted and might not be very resilient to those individual households, might not actually be very resilient to sort of external economic shocks, whether that's the loss of a job or something relatively mundane like the washing machine breaking down and being able to having to access credit to address those sorts of shocks. And a number of other sort of local authority, city-wide initiatives to try and address processes of nominally of financial inclusion have used the term financial resilience rather than financial inclusion. Second endeavour to try and address the limitations of the concept of financial inclusion is to go back to the 1990s and a concept that was coined by Andrew and others of financial citizenship. And interestingly, although financial inclusion was taken up by in the wider policy community, actually financial citizenship was made relatively dormant, and it's only been recently by people like Mark Keir who have sort of gone back to that concept and tried to think through its utility, its strengths and weaknesses, both as a concept, a theory, but also as a sort of a way in which to intervene in policy debates. Key difference with financial citizenship, like financial resilience, is it allows for maybe a sort of broader conceptualization and a broader sort of intervention in terms of these debates around the distributional politics of financialization and mass finance. So it's about focusing on what sort of rights should an individual have access to in a highly financialized society. How is citizenship changed by financialization? And again, that might relate to financial inclusion, but it might also, I think, more importantly, relate to a broader sense of financial rights and citizenship rights. And Craig Berry, who's based at Sheffield, has written some really interesting stuff over the last couple of years, sort of trying to think about the relationship between citizenship and financialisation. And I think the most interesting aspect of his work is this focus on the way in which financialisation hollows out some of the political, the sort of traditional political entitlements of a citizen and of citizenship. He basically argues that if you think about the recent financial crisis and the way in which the banks were bailed out during that financial crisis, and the lack of public debate and public accountability and political accountability in terms of that bailout, that really highlights the way in which financialisation, as what he argues, has sort of hollowed out traditional notions of citizenship. So any sense of sort of deployment of the notion of financial citizenship has to go beyond a narrow focus on financial inclusion to address these broader issues. Okay, so that brings me back to the Nottingham Financial Resilience Partnership, and just although in sort of theory I have a lot of sympathy with these sort of critiques of financial inclusion, and I've been trying to work through ideas of financial resilience, ideas of financial citizenship, and try and think about their sort of strengths and weaknesses and how they could be deployed in terms of these ongoing debates. I think from my sort of practical experience, working with Nottingham Credit Union, working with Nottingham City Council, working with Nottingham Advice Nottingham, sorry, and other debt advocacy organisations, that actually financial inclusion still has a lot of purchase, both discursively, politically and institutionally. So that raises issues around how, practically how you can dislodge the idea of financial inclusion and try and think about, resilience or citizenship and how, or financial rights and what that actually might look like on a sort of, in terms of a local policy initiative. It also raises questions because, in a sort of very mundane level, in terms of the lived realities of people who are struggling with poverty, with marginalisation, socioeconomic marginalisation. A lot of those issues are around, getting access or not being able to get access to things like basic transactional services and affordable credit. And that doesn't sit very comfortably, really, with a lot of those critiques that I've just outlined. Also, a lot of the issues, if you talk to, debt advocacy groups, one of the things that will come out time and time again is that one of the real problems is around the lack of financial capability and literacy. So people are over indebted, they aren't able to distinguish between, priority and non-priority debt. And so therefore they aren't able to start to get themselves out or address the sorts of problems they're already in. So there's a real sort of set of dilemmas around, these sort of conceptual critiques and the sort of practical issues around, trying to help people on the ground or develop policies to help people on the ground. So I thought, what would be really useful in terms of the debate, the discussion, is to get your feedback in terms of, what you think about these debates about the critiques of financial inclusion, exclusion. Do you think it's, has it outlived its critical usefulness? How do we address the sort of limitations of financial inclusion policy at the same time as trying to recognise the sort of lived realities of indebtedness? So to what extent do concepts like financial citizenship, financial resilience allow us to overcome some of these limitations, or whether they just create further sort of conceptual and political difficulties and limitations in terms of understanding these distributional politics? And are there other alternatives in terms of thinking about these sorts of issues?
But we're quite happy to field other questions as well.
Yes, of course.
So we wouldn't want to say these are the only ones we could ask. So. Okay, over to you.
Well, thanks, Andrew and Shaun. That was great and really enlightening talk. There are already 2 questions in the chat that I could read to you, but I would open first to anyone who has a microphone. I personally also have a couple of questions, so please feel free. to use your microphone now and ask questions or directly addressing these. Shaun just put up on the screen.
Hello.
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 Hi. I asked the first question. I'm Hannah. I'm finishing my PhD at Leeds, and I've been working on the link between financialisation, household finance and inequality, but I'm now looking more and more into the financial inclusion story. And I was wondering, when you were showing the data on the decline in the inner city branches in the UK, did you take into account at all the density of the overall bank branches? Because if a branch closes, but there is another one available to the inner city customer within a reachable distance, then the effect may be different than if it's a real kind of lack of access resulting from these closures.
Yes,
no, that's
a very good point, and there is certainly an element of that, because a lot of these branch networks are a result of long-run processes of capital centralisation and concentration. So in the UK, they traditionally had kind of 4 very big banks, and part of the reason they became so big was by taking on other banks, and also the similarly with lots of building societies. But then they also kind of merged with other building societies. So there was a lot of there was some thinning out to do, I guess, if they in terms of rationalisation when they felt they had to do that. So that certainly is a part of it. And also when we were doing interviews with some decision makers, some leading decision makers in banks. One of them, who actually was a geography graduate, I remember, who was had been taught by David Harvey, which was a kind of interesting interesting experience. But he said it was almost as if we didn't quite use this term, but it was almost like a kind of spatial fix to some extent, that these branches, because these organisations have been in operation for such a long time, that many of them are just in the wrong place, because at one point they were in areas of growth and dynamic activity, and they were no longer. So a combination of two things: yes, a kind of overlap because of growth, and the distance to bank is not so far, but that and also that they in kind of just not very dynamic areas. But beyond that, there was also closures in places where they just wanted to get out of, because there wasn't the right kind of business, and it was costing them money or not making them enough profit. And at one point there was a sort of a race not to be the last branch anywhere, that they wanted to if they could see the branches were starting to go, they didn't want to be the last one, because for 2 reasons. One, they would get all the business that presumably all the other banks wanted to get out of, and also they would become a point of critical protest. So once one started to go, they were very attentive, and they tried not to be the last branch.
I think initially, I think about 10 years ago, the industry did sign up to a voluntary agreement which was related to the last branch in town, that they wouldn't close a branch if they would only close a branch if there was in a rural area there was another branch within 3 miles, in an urban area within 1.5 miles, to address the sort of issue that you've just highlighted. But that's gone by the wayside now, and certainly I did a piece to camera recently in Castle Donington, which is just down the road, and where they've just closed, I think it was the HSBC, and the nearest branch I think is about 6 miles away, which is obviously, even if you've got a car, that's a significant journey. So that sort of geography, in terms of those sorts of policy debates, has been sort of sidelined a bit.
Thanks for that. Just a quick follow-up question from Joanna, who can't use her mic. She wanted to know if in an era of increased mobility, meaning workers living in the suburbs and working in services in the center, or internet banking, if in this era geographical bank dispersion is still a relevant measure.
Well, it is certainly less. It is less relevant in that it's increasingly possible for people to exist without money. Yeah, and working at university, you see this with students all the time. You know, it seems like students don't carry any cash around at all. Where you're waiting behind them in queues for things like coffee and so on, that they will pay for anything with a card. So, but in a sense, so there are alternative distribution methods, but that's always been the case. But there is still something important for physical access, and you know, perhaps increasingly for a certain demographic who are elderly, who are poor, who want that kind of reassurance, who haven't got that kind of access, haven't got the kind of competence with new technologies. So, but it's always been that. It's always been a kind of minority of people that is affected, is whether they matter or not. So that's been the issue. And where it tends to matter is where things become quite vocal, is in certain kind of rural areas where there's sufficient people with enough social and cultural capital to make a fuss about it and to embarrass banks about closure. So why Shaun was on that TV program the other day.
It also really matters for SMEs and low sort of small traders, because they're basically mostly still operating in a cash-based economy, and so they need that sort of frequent access to a bank branch to be able to cash up at the end of the day and access cash at the beginning of the day as well. And what's happened is that increasingly SMEs are finding it difficult to be able to do that, and there's significant costs in terms of having to travel further to be able to cash up. And also there's been an increase in terms of the use of the post office in those sorts of locations where the last branch is closed. And that's putting pressure on the post office. And in the UK, the post office is going through a process of restructuring as well and closing branches. So there's this sort of knock-on effect. But as Andrew suggested, certainly the elderly, people who've retired, people in their 50s, they are really, really significantly affected by bank branch closures, because they either don't want to or don't have the skills to use alternative distribution channels.
And the other kind of effect, there's a sort of spillover effect in certain places where bank branches close, because certain local shops or local businesses would benefit from people making that journey to bank, and then they would kind of get, you know, while they were doing that, they would be doing some other things. If the bank's not there, people are not making those journeys, and then they're having a loss of footfall and a loss of expenditure. Hello.
Thank you for this answer. Now, I think Renan has a question. There are several questions, Renan and Yuvara. Renan? We can't hear you.
You can hear me?
Yeah, now.
Okay. So guys, thank you for the presentation. Well, basically many of the points I would like to discuss, it was implicit in Johanna's question. But well, just adding some comments. Well, in the end of the last year, I published a paper which has very similar results, and it was for a Brazilian metropolis, the one where we live. And well, we realized that many very rich suburbs have very few bank branches as well as bank posts. So I'd like that you comment the probable effect of car ownership and also of internet banking for this kind of public. On the other hand, we know that many of the low-income districts has a very high rate of new bankings, both branches as well as posts. So we are noting this kind of phenomenon here in Brazil. Now I'm going to share the link for the article if one would like to see it later.
Yeah. Okay. Thank you. Like to see that. Yeah, it's interesting.
Thank you, Renan, for this comment. So I think next in line is Yuvaria. Please feel free to ask a question.
Hi.
Hello.
Hi.
Hi. So that was really, really interesting. My own research is also about financial inclusion from a developing country perspective.
Yeah.
And one thing I've been sort of struggling with is trying to identify that precise link between financial inclusion in the West and linking that to the time when it sort of became mainstreamed in developing countries. So you had microfinance, and then you have this point sort of in the 2006, 7, 8 or so, where financial inclusion becomes the mainstream term. And although it was already quite widely used before that in the UK, for instance. So do you think it's possible to sort of identify exactly when they sort of became almost interchangeable?
It's an interesting question. I wouldn't be able to identify, but I think what it links to is a wider issue that people like Jamie Peck has talked about in a wider context of neoliberal economic reforms. That he talks about fast policy, that people are constantly looking for policy solutions to social problems that can be rolled out very quickly. And he's talked about this through a whole range of things to do with labour markets and welfare and support and so on, that they get experimented with in particular places, and they can move very quickly from local places to a kind of international policy making institution and then rolled out right across the world. So you could imagine the sort of fuss that was being made in the West about financial exclusion and inclusion, that would then be, if you've got somewhere in like the UK where you have a number 10 policy unit that's kind of rolling with these things, that they would transmit very quickly to wider policy making fora and then be seen as something that could be rolled out. But what's really interesting about this is that in the 1990s, when people were confronting this in the West, what they were looking to was solutions in developing country contexts, because things like microfinance, but other forms of informal finance were, as you will no doubt know, are kind of traditional ways of dealing with precarity, and they were looking for ways in which those things could be introduced into the West. So experiments of things like local exchange trading systems were influenced in part by what went on in more precarious economies. There's that fantastic book by Ferguson on the Zambia copper field about expectations of modernity, and talking about those places that actually held on to certain kinds of traditional ways of operating their economy did best when the whole thing collapsed. So it's interesting that, first of all, looking at developing country context for solutions to finance that could be done through community, but actually that gets turned around and you get this idea of financial exclusion coming from the West into developing country context. And I've been reading again Roy's Poverty Capital, and what happens there is that you have microfinance, which is seen as a local solution, but as a way to sort of turbocharge that, it gets linked up with international capital and turns into something that becomes something quite different. So it's you have sort of local solutions that are quite that operate at their own speed. You try and roll these out faster, but you run into all kinds of other problems. But that book's a good example of how these ideas get picked up by international policy units and policy institutions and rolled out, and in this case through the World Bank.
Thank you for your answers. Are there any further questions from the audience? I think the chat, we all handled those. If not, I was curious about you spoke about financial citizenship and the danger of banks and financial institutions assuming a role that the state should have. So I just wanted to know, would you think that would require a full concept of financial citizenship would require a state-owned bank then to work? And I had the luck to do some research on credit unions in the UK, especially in Scotland, and interviewed some people, and they didn't show up in your categories of alternative financial institutions, Shaun. So I was wondering how do you see their role in this process, and How do they fit in this picture?
Thanks, great question. I'll answer the second part first. I mean, part of the project I've been involved with a colleague at the University of Coventry, Lindsay Appleyard, was to try and think about financial citizenship in the context of the UK credit union movement. And we conducted some interviews, and we got together a workshop, got some credit union managers to come along, and we talked about the notion of financial citizenship. We talked about some of the problems in terms of this discourse of financial inclusion, exclusion. One of the big issues really is the lack of capacity in terms of the credit union movement. So, you know, just on a day-to-day basis, they're sort of struggling to get by. So to try and move beyond or challenge, you know, the sort of hegemonic discourses and also initiatives around financial inclusion was clearly way beyond the means of the credit union movement. I mean, of course, conversely, in terms of the credit union movement, it is in a lot of the financial inclusion literature, certainly in the UK, it's identified by the government as being this sort of this magic solution to bank branch withdrawal and withdraw the banking sector more generally from particular segments of society, that credit unions can just step in and take up that slack. And that's problematic in all sorts of ways. You know, going back to some of the critiques of the idea of sort of financial inclusion, because it doesn't really, again, it sort of papers over the sort of more structural problems that are driving these sorts of processes. In terms of the first part of your question, I certainly think that in terms of transactional services, it means that that we have to rethink the role of the private sector, private banks in terms of supplying those sorts of services, because there's a huge disconnect and contradiction, particularly in the UK, because the welfare system's being restructured, and as part of that welfare system restructuring, we're having something that universal credit's being introduced, and that basically means that anybody who wants to get access to welfare has to have a bank account. Okay, but at the same time, so you know that's a sort of fundamental right of a citizen, a public good. But at the same time, in order to be able to get access to those welfare payments, those sort of marginalised individuals, households, have to negotiate the private market, the private sector, the market, and the banks are very good at, you know, not sort of explicitly discriminating from and preventing people accessing basic bank accounts, but doing this in a much more sort of implicit way. So making it incredibly difficult for people to negotiate, to negotiate application forms, the sorts of ID they need to be able to get a bank account, which is a roundabout way of saying that yes, I think the state does need to intervene, and there needs to be, you know, the sort of unquestionable right, certainly in terms of bank accounts, for people to be able to set those up and actually to be given a bank account really at the age of 16. And I think that, you know, certainly in the context of the financial crisis and the fact that the financial system was bailed out and continues to be bailed out, you know, I think a really strong political case could be made for that. And I think it's really essential. So I think, you know, trying to distinguish between, which is something a lot of the financial inclusion literature doesn't really do, certainly the policy initiatives, between, you know, sort of fundamental transactional services that are actually, everybody needs those, you know, in a country like the UK, and then other debates around things like credit and the debates around affordable credit, which I think are more problematic. I think that distinction needs to be made.
Oh, thank you. That was really helpful. Great. So, any further questions? We just also reached our 1 hour limit. So, if there are no further questions, well, I would like to thank Andrew and Shaun. This was a really great and, for me personally, a very enlightening webinar. And I hope to hear more from you in the future. And thanks to all the participants and interesting questions we had. A very quick note: we will continue our series on the reconciling financial stability and economic inclusion across space in about 3 weeks' time, and we'll cover a topic on cryptocurrencies and financial inclusion. So you'll get the link through the YSD as soon as the time is fixed. And yeah, thank you everybody. Andrew and Shaun, we will provide the material we just recorded later to you. And thanks again for taking the time. And if there are no further questions, we would close the session.
Okay, thank you very much.
Thank you for the invite.
That was good.
Yeah, it was. Thank you.
Okay, bye.
Cheers.
Bye-bye.
Bye-bye.